So let's just get some perspective on that. Anindya Banerjee of Kotak is with us, as well as Bhaskar Panda, Treasury Advisory at HDFC Bank is with us. Anindya, let me start with you. What do you make of the recent correction in the bond prices, first in India, and then we can talk about the global yields as well?
The conditions have become quite favorable for the bond market because the liquidity is at a substantial surplus. Globally, though oil has perked up a bit overnight, but still it's below 70, so that's not a problem. Commodity prices are lower because global economy is weak, and now RBI is talking about cutting rates. They also want to use the surplus liquidity to transmit the cutting of rates. And another additional factor which has come right after the budget is now the government will go in the offshore market and borrow, so which is going to reduce the crowding out effect. So all these things are fantastic news for the bond market. So yields can continue to fall because the term premium, means the difference between the 10-year and the repo, which was above 100 basis points, have started to shrink. And we believe with a slowing economy, with a surplus liquidity, it can shrink quite further, and the 10-year could be headed below 6.
Okay, great. So let me also get Bhaskar Panda on this. Same question to you, Bhaskar, in terms of, do you think the steps taken, particularly even what was announced in the budget, right move to mobilize funds?
Right or wrong, we will come to know once we are in the markets. And obviously, it's a new move by the government to diversify from only India-centric to probably global-centric. There are positives in that. For example, when India goes to markets, then you will have a bond index and you will have a yield curve which will be available to global investors. Obviously, there will be some negatives as well. Government has to be more responding to the global investors' demand, so on and so forth. So that's a good move actually. Now, if you ask me, it's definitely a good move to diversify from India-centric to probably come out with a global yield curve or something like that. Second thing is that as my predecessor said, Anindya said, liquidity is high in the local markets. The yields are falling in global markets. People are, chasing yields, higher yields where India stands. So India has a better yield than many other, even emerging markets. So, and we also have seen that, on the FX, rupees appreciating against a dollar. So all this is actually converging to give you a perspective that, further movement in yield is possible towards the downside. However, whether it will go to 6% or not is something which you can debate. Probably the next stop would be 6.5 and on the 10-year yield benchmark. And after that, depending on the demand and supply, it will move. But yes, there is a possibility that it can move below 6.5. But in the short term, I think 6.5 will be, quite supportive.
Right. Anindya, I also wanted to get a sense that, what is this? How would you look at global yields into this context? How would you look at it on that front? Is global yields coming down also a reason why the swiftness in the fall in Indian yields? Anindya, that one's for you.
I think it is definitely influencing us.
Right. Go ahead, Bhaskar. If you've started, go ahead. Then we'll take on in this.
Sorry. So definitely influencing us, and probably if we see more of global yields coming down, we can see that reflecting in Indian yields as well. So that's definitely one of the factors that is behind the yield curve here in India as well.
What do you think, Anindya?
Yes, because it actually incentivizes the carry trade because let's take the US 10, which is around 2, and the Indian one is 6.5. The 450 basis points with the bull market in bonds, with a very positive outlook towards the rupee, it becomes extremely attractive. And there is enough unutilized, say, limits in the government bond space which the FIs can use, So yes, it will attract a lot of flows.
Do you think any risk to this,
Yes.
this kind of outlook given what we may see even on the global currency front?
Absolutely. The risk is a trade war. If again the spat between China and America starts, it can lead to outflows from emerging markets, and that can lead to a reversal of flows. But what we have seen in the past, let's say over the last 6 months, is that even when the trade spat was on, bond did not see much of an outflows as long as oil prices are lower. If oil prices start to spike towards $80 Brent, I'm talking about, yes, that is the risk.
Okay.
Otherwise, it's fine.
Right. Also, one interesting thing I wanted to point out is that 10-year yields are now going towards almost the FD rate.
Right.
What does that imply? FD rates need to come down? What does it essentially imply?
The transmission from the government market to the retail market or the corporate lending market is not happening. That transmission is impeded. So over the last 6 months, if you look at what happened with the repo, it has come down. The yields have come down, government yields, but the lending rates, the deposit rates have gone up. So that transmission is getting impeded due to a host of factors. So this kind of an anomaly may stay.
Yeah. Okay. What about the appetite, Bhaskar, for the sovereign bond? Do you feel it's going to get a good response? What do you feel?
Sorry, I couldn't hear it.
Appetite for the kind of sovereign bond the government's looking at in the foreign markets. Do you feel there will be a demand for it?
I think there is demand. As I said, all the bonds which are high yielding and with, stable exchange markets will always attract funds. So therefore, there is definitely going to be demand for Indian bonds. So as we have seen for other sovereigns as well. So demand would be there. There is no doubt about that.
Also, what does it do, when you get listing over there? Does it, make India on the radar of FIs? A lot of FIs who were not looking at investing in India earlier, are they forced to invest into India?
They could, what will happen is that there will be a sovereign benchmark yield, developing in the markets, which was as of now is absent. So that will definitely, give some, visibility to global investors. So people who are avoiding till today probably could see it as a, opportunity and invest. So definitely there is going to happen.
How do you think, the government will be able to redesign the bond issuance in order to attract the foreign market?
Yes, in fact, if you see the equity market as an example, of late, a lot of the flows of FPIs are happening through ETFs. So I think that same thing will happen in bonds. It may take a little more time, but once we start the international issuance and it becomes a part of an index, then you will see a lot of money which was not coming into India because we were not part of an index, let's say JP Morgan or Barclays, then that will start coming to India. But we have to understand something, government will just go slow. So it may be just around $10 billion at most in the beginning, but it will be a very positive step.
Right, and what will that do for rates? Everybody has focused that rates over there are cheaper, even if you hedge for the rupee. Can you just explain that? What could that mean for rates in this?
So let's take the US 10, which is around 2, and considering our sovereign rating, it would be around 80 to 90 basis point over that. So we get it around 2.8, max 3. 3 and now it's 6.5. There is a wide differential. Yes, one can say because it's in dollars, the other one is in rupee, the rupee risk is there. But still considering that, I think the rates will compress. That's the reason why I said over a period of time, there's a high probability of the 10-year yield going below 6.
Yeah.
Right, and what will that do for the overall 10-year benchmark? Is the reason for the little bit of appreciation that you've seen, or the point that you made about $6 factors in this particular $10-15 billion?
Not really, because it will be there is still scope for money to come into the rupee bond market as well as in the dollar bond market once that is issued. And with what happens, it's kind of a Goldilocks scenario. So more flows come in, the bullish the outlook for the rupee becomes. the stronger the rupee gets, more people want to buy the INR bonds. So the flows will happen in both the offshore bonds as well as in the domestic bonds.
Right. Bhaskar, just a last word to you. You know, we asked on India just before this that 10-year yields are getting closer to the FD rates. What does that mean? Do you think FD rates will start to come down?
I don't think so. I think there is not direct one-to-one relationship between these two, because transmission is different, and government yield, bond yield is different. So I don't think they are going to converge in the near future. So I think that will remain, and the difference between these two is going to remain. The FD rates and all those things will also depend on how the domestic savings is shaping up. So domestic savings is something which will probably influence FD rates rather than anything else.
Gentlemen, thanks so much for joining us this morning on really the outlook when it comes to the bond market. So we'll leave it there. We need to take a very quick break. Back with more.